In this week's update, small and mid-caps rebounded, but the short-term outlook has not changed. Longer term remains bullish, but quality is vital. And the Fed will remain the centre of attention. My name's Garry Davis, and as always, this is general advice. And please remember to like and subscribe to the video. Okay, look, last week I made a call that I've rarely made in the last decade. You could count them on one hand, the times that I've shifted a bit to the bearish side in the short term. And I think most people got it, judging by the feedback that I got from members and others that watch this video who are not members. But a few seem to seize on some bits that I think fitted their beliefs. And look, that's normal for everybody. We tend to see the world through the lens that we feel most comfortable with. But the key to successful investing is about being able to look at the facts through a more factual lens, a less emotional lens, if you like. And I do these videos every week, and I've been doing them for 15 years or more to help investors with perspective on the market. So in the interests of helping you to become better investors, can I suggest in the future, when you're faced with a call that is making a change in direction, be it bullish or bearish, whether it's by me or by others, that you just take a deep breath, clear your mind, and re-watch or reread that video or that piece of information, because there's a good chance that you might have just filtered out. You've filtered in the things that suit your belief, and you've filtered out some of the things that are contrary. And so you can end up with an incorrect conclusion, as a few people made last week. So just to recap, what I said, or what I intended to say very clearly, and I apologise if I didn't do this as well as I otherwise might have, but what I meant last week was that long-term, my bullish orientation remains completely unchanged, no difference at all. But inevitably over the next decade of this secular bull market, we will run into times when there are corrections. And some of them might be nasty, like February, March of 2020. In fact, I'd be amazed if we don't get several corrections of between 20 and 50% in the next decade. But having said that, I'm still bullish, and it's with good justification for where the price of many stocks are going over the next decade. What I was signalling last week was the speed of the shift, the speed of the change, and the size of the change meant that in the short term, because of inflation and comments made by the Fed, that we could see more of a corrective phase in the market short term. I also said that there were differences between the Australian market and the US market, and I'll cover that off again today just to be really clear about what I mean. Now, 1 week on, I think things have panned out pretty much as I would have expected. We saw the low in the low in the market. I said I thought in the next few days we would see a low in the market. Well, we saw it almost immediately because we were at that very high VIX level. And the market has gone up, but nothing has really changed. So my call about changes in the short term remains unchanged from last week. I just haven't seen any evidence to the contrary at this stage, but it's a bit early to say. So with those opening remarks, let me just cover off the perspective that we can see at the moment. So to me, there's a mix of short-term dynamics and longer-term things that are playing out here. In the very short term, there's no question that the practice of tax loss selling of underperformers during 2021 occurs in the States. And so stocks that have lagged or gone down and therefore would be negative in some people's portfolios are sold to balance out against winners. And that process will always happen. So I think if you've got a stock that's been an underperformer all year, you probably shouldn't expect too much in the next few weeks in terms of recovery. The second thing is that there are just multiple cross currents all over the place, from inflation, from the Fed policy, from supply chain issues, and how the market's going to respond to those. And it's really a very tricky market. You know, you look at Friday night, or let me wind back a bit, you look at the inflation numbers that we've been getting over the last few weeks really spooked the market. But then we get an inflation number which was even worse on Friday night, and the market thought it was good because it was slightly below expectations. So it's a very confusing, very tricky market with lots of cross currents. Just makes it a bit more unpredictable and really plays into exactly what I said last week about being a bit more cautious, demanding lower entry prices, etc. Now, on a less short-term view, so these are the less transient factors, the ones that are likely to be with us for longer, we've been getting a rolling sector rotation all year, which is why the S&P has continued to go up, seemingly oblivious to what's going on around it, because we are actually been getting a correction of sorts throughout the year, because it's been on a sector-by-sector basis. But when you lump all 11 US sectors together into the S&P, you don't end up with much of a change, because some go up, some go down, and it really doesn't affect the individual. And that's why it's so important to look at individual sectors and to look at the spread charts that I look at every week. So as a result of these rolling sector rotations, it's been screamingly obvious to me all year that you really shouldn't chase prices at all. You should be waiting for more significant dips. Now, there's been some tremendous breakouts in the US that have been worthwhile following, but they're not as good an entry as a stock that's in uptrend with great growth, great fundamentals, and you wait for a decent dip. You might have to wait 3 months for that sector to go through its little correction. But if you buy in on those sort of corrections, it's been an extremely profitable entry point. The second thing that's sort of less transient is that high yield credit spreads are now starting to widen again, as they should, because credit spreads have been, so that's the difference between high yield junk bonds and high quality lower yield bonds. There should be a big gap between those two yields to reflect the risk. But all year, in fact, for several years, that gap has been unreasonably low. And so therefore, people are taking on board a significant amount of extra risk in buying junk bonds, but not really being rewarded for it. Now, those credit spreads are now widening back to where they were at the height of the pandemic. And I'm not quite sure how to read that, because that's sort of contrary to things that we're seeing in the stock market. So this is another cross current that just, throws uncertainty into the mix. But that's certainly one that I'm watching very closely. And the other less transient factor is, I think, and this is again referring to the US, small caps are clearly not in favour. They haven't been in favour all year. Really, you've got to go back to November 2020. And therefore, small cap stocks that are going to do well are going to have to be exceptional. Otherwise, they're just not going to be noticed. So I think the way to think about American small cap stocks is to think that they're probably going to be underperformers unless proven otherwise. Now, I still actively trade some US small caps, because there are many with a great story and a great outlook. So I'm not just turning universally bearish on that part of the market, but my approach has changed. Whereas I would have taken a punt a year ago, now I need to be, my base position is they're probably going to underperform, and I need to be convinced that they will outperform. So that's a bit of a shift. Now, the inflation data that came through, the CPI came in at 6.8 on Friday night, which is the highest in 40 years. So you would have thought that would have been the nail in the coffin for the market, having already reacted badly the week before on higher inflation and the Fed comments. But not to be. The market apparently, we can never know this in advance, but the market was expecting something even higher. And so therefore there was a bit of a cheer, and large parts of the market went up, especially the more aggressive sectors, technology and consumer discretionary. So if we look at how the US market responded, quality growth rose very strongly. Apple was up strongly, so was Microsoft. So big tech did quite well out of that, and that was despite the fact that the 10-year yield went up. Now, small caps generally were down. There were a few exceptions, but generally small caps did what they've been doing for most of the time. And also, interestingly, the ARC funds, which was so much in favour in 2018, 2019, if you wanted to make a stack of money, that's where you put your funds. But the ARC funds are now being completely shunned. There is even an ETF now that bets against the ARC funds. So these are all the speculative but ultra high growth stocks of the future. And so the market has turned quite bearish on that part of the market. Now, if we turn to American stocks, the S&P was up 1.6 for the week, so a pretty good week. And what I said last weekend about we'd come off an extreme of 35 in the VIX, and that was highly likely to produce a low in the next few days. We got it pretty much straight away. What we're seeing at the moment is that quality growth stocks and quality value stocks are both getting plenty of support. There's not really a great difference between the money flows into those two areas, and we'll see that on the spread charts. But clearly, speculative growth is not getting support. So that's the area that you need to be very careful of. Now, we saw a nice rebound in small caps, but none of the moves seem justified by the fundamentals to me. So I'm still of the mindset that I was in last weekend. I've not got any information that would change that. So I'm still short-term cautious, long-term bullish. US dollar, steady again, dropped less than 0.1 of a cent. And the 10-year yield went back up to 1.49, having been down in the mid-1.3s. And the VIX has come all the way back down from 31 back down to 18.7. So quite a significant shift. However, the thing that we don't have at this point in time is we don't have the Fed response to the inflation data, and that comes next week. So the Fed still has the capacity to disrupt the markets again next week. So I'm sorry if you want a nice clear period of plain sailing. It's probably not going to happen. It's just going to be a continual series of potential triggers that can move the market. And that's why your process needs to be as bulletproof as you can make it. Because if you start reacting emotionally to this market up and down on these very significant daily turnarounds, you're going to get in a heck of a mess. So just work on that game plan and get it as robust as you can get it. All right, this is the S&P. So this was last Friday. So we had a down day. We opened slightly higher on Monday and then just took off from there and finished really quite well. So that's the S&P. I think it's an all-time closing high. In fact, it is. There's a new all-time closing high at 47.12, which on the surface made my call of last week seem strange. But my call was not because of what the S&P looked like. It was for a lot of other reasons that I want to take a look at. So let's look at the small caps. So this is where the small caps were last Friday, looking quite negative, near the bottom of the range. We did get a jump up on Monday, Tuesday and Wednesday, but you can see how well the S&P finished on Friday. But look at the small caps. Small caps were down. Now, volumes are also declining, and declining volumes is a feature of December, January for obvious reasons, people on holidays. So it's a bit harder to determine when you see a fall in volume. Is that a fall in selling pressure, or is that just a function of this time of the year? I don't have the answer to that, only to just be aware when you're looking at volumes. If you see volumes drop off, just put it in the context of the time of year that we're in. But there's no question that small caps are underperforming the rest of the market, and that in itself, and the speed of that change from breakout to back down to the bottom of the range, it was that speed that caused me to make my shift last week. And this chart is not really giving me anything different to what I saw last week. Now let's look at the mid caps. Pretty similar. We had a breakout in the mid caps. It was a good looking breakout, and then it all fell apart back into the range. Now again, mid caps doing a bit better than small caps, so they sort of sit in the middle. So no surprise there, but mid caps were neutral to negative on Friday night. You know, there's not the strength that we saw in the bigger end of town. So it's very, very clear in the American market that you've got to stay with high quality, either growth or value, but you know, high quality large cap stocks in the main. This is XLK. This is the technology sector. As you can see, new all-time highs. Very strong finish on Friday, and the volumes actually picked up on Friday. And you can see just how much the technology sector is outperforming the S&P. So that line is rising. That means the XLK is outperforming, and has been for quite some time. You've really got to go back to about May of this year. So clearly that is one of the areas that you want to be in. Now, consumer discretionary still showing strength. We've still got a nice, sustained, really nice breakout from this last little consolidation we had. Not as strong as the technology sector, but it's not too bad. This is XLF. So finance did well. It also broke out, but that has failed. We're back in the range, and now it's sort of a bit undecided. Doesn't know where the yields are going to go. Obviously, rising yields are better for banks. Falling yields, not so. This is the industrials. So this is a pretty broad church. Not really sure that I'd call this a breakout. Very minor, sharp plunge in industrials. Now, we did rebound quite nicely and managed to hold it. So again, that's a bit of a neutral picture for me. And this is utilities. So if you want to look at the extreme end of the defensive sectors, then this is utilities. And money is also flowing into utilities, as you can see. We had some nice volumes early in the week. So that's why I'm pretty clear in my mind that we've got a broadly equal flow of money into both aggressive and defensive sectors. Let's look at some of the spreads. So first of all, the Russell 1000 growth, so large cap growth versus large cap value, not a lot of change. So pretty neutral there, both areas being supported. This is consumer discretionary versus staples. You can see staples probably still winning a little bit in the short term. So there's definitely a bit of a defensive bias in the mindset of the market. And this is the small cap growth versus value. They're all relative to large cap. They're doing worse. But again, money, it's not really anything different between aggressive and defensive. It's really more about small caps in general just not getting the support that they got in 2020, and we just have to recognise that. Now, if we look at the US dollar, not much change, really just been consolidating this breakout for a couple of weeks. But the Australian dollar did improve and held those gains. So again, a bit of the Australian currency really is a reflection of the global attitude to either risk on or risk off. When the attitude is risk off, then we're going to tend to do worse than what you'd expect. So that's worse than other currency relationships. When the attitude swings back a bit more to risk on, then the Australian dollar is probably going to go up a bit more than you would expect. And the Australian dollar went up a bit more than the US dollar went down. So quite a strong week for our dollar. Turning now to the Australian market, we're at the same level now that we were at in June. So we've really gone nowhere at the index for almost the entire second half of the year. Material stocks is a material sector, so reflecting all the major miners, was obviously a big part of that. That was a lot about the iron ore price plunge. We've done a partial recovery, so that's not too bad, but we've only recovered about a third of the fall that occurred from August. If we look at energy is had a good run there for a while, but it's been quite negative of late as the oil price has come down. Finance was looking pretty good there at one stage, but in the last few weeks, finance has really come off the boil quite a bit. Healthcare it's just got a bit volatile because of a few specific deals in the healthcare majors, but really just tracking sideways. And if we look at small caps in Australia, nothing too dramatic there. The small caps in Australia are doing better relatively than small caps in the States, and I think a lot of that is because we've got a lot of the battery material stocks. We've got some outstanding small cap fintech stocks. We've got some great stocks in the medical field that are small caps, and they're all getting recognised by the market. And I think our market just supports small caps more readily than they do in the States. So just confirming on Australian, 71.15 is where we finished. So we've managed to scramble back into the trading range. Our index also was up 1.6% for the week, but that's only just coming off some previous selling. And all sectors in the Australian market are really a bit less than convincing at the moment when you look at those sector charts. Turning now to precious metals, gold was flat for the week at 1783. It was just a nothing week, really, nothing much happening, and it appears that gold and precious metals just really aren't gaining the support that you would think the environment would indicate they should. As we'll see in the chart, the gold price is still just hugging the boundary of the channel, but that is a channel that is falling. So we've broken out of the channel and now we're retesting the top of it. And precious metal stocks were pretty much the same. Didn't do anything much. So we'll have a quick look at those. So we'll look first. Bitcoin. So Bitcoin, from our breakout, we continue to work down. We're now down under 50,000. But I'm just an observer with the Bitcoin. I don't have any opinion as to direction. I just present it each week because I know that increasingly more and more people are interested in the Bitcoin price and maybe don't get the opportunity to see a chart. So if we pan back and take a look, there's a bigger picture chart. So when we were down around 10,000, it was only a bit over a year ago. So it's been quite an extraordinary run for Bitcoin. This is precious metals on a daily basis. So you can see just really a nothing week, just completely sideways. Here's the downtrending channel that we had been in since July of last year. We broke out, formed a new short-term high, but now have come back and are really just sitting around the top of that channel. So it's very hard to pick the direction. Silver, though, is doing worse and has gone back now to underperforming the gold price as well. So to me, it's just a sector you just really don't want to do anything much in, to be honest. From a trading perspective, it's just not going anywhere. If you want to hold a certain percentage of your portfolio in precious metals for the long term, in gold as a hedging mechanism, absolutely fine. That doesn't change. But in terms of trying to trade gold at the moment, it's very difficult to pick the direction up or down, and the moves aren't all that large. So perhaps a lot of risk for not a lot of return. Other commodities, copper and nickel, were both lower, not by a lot, but a bit, and the long-term themes remain intact there. I don't really have anything further to add from previous weeks. Crude oil was up above 80, plunged into the low 60s last week, and then recovered to nearly 72 this week. So it's been a real roller coaster. The prior week falls always did look to be ridiculously overdone. To fall from 80 to low 60s in an environment where just chronic underinvestment and almost certain underinvestment forever, as fossil fuels gets phased out, is going to be supportive of the oil price. It just is. There's no way that the oil price, unless demand just completely collapses, but you can't see that happening while society continues to do what it does. So, I think we're looking at 70 to 100 plus oil for as far as the eye can see. There's the spot copper chart. So not much change in spot copper or nickel. Wrapping it up, there's really no change from what I said last week. America, stay with the high quality stocks. The high quality, my preference is for growth, but there's certainly some high quality value stocks as well. But America's definitely putting more money into the larger cap quality stocks for sure. In Australia, though, the situation is a bit different. The small cap mega trend stocks remain well supported. They've just become more volatile. So where we might have seen up and down swings of 5 and 10%, now we're seeing, 20, sometimes even 30%, as we saw with a stock called Novonix the week before last. So more extreme swings. I'd like to tell you that it's all going to settle down and they're going to go away, but I'm afraid I can't do that. I think higher volatility in small caps is going to be a feature. And again, that's why the robustness of your game plan and the clarity around what you're trying to do is just so critical. Because if you don't have conviction about what you own and how you're managing it, those sort of swings are going to scare the pants off you, and you're probably going to sell when you shouldn't. And then when it rebounds, you're probably going to buy when you shouldn't. So getting clarity around what you're doing is just so critical. So stock selection for me has never been more important, because I think the really good growth stocks are going to win out massively over the stocks that are being disrupted, the stocks that have got an old business model. So I would absolutely not get caught up in doing following conventional wisdom, because conventional wisdom reflects what was appropriate 10 years ago. There's that sort of lag for conventional wisdom to gradually change the way that it sees things. So if you're following the conventional portfolio construction models, then I think you're going to be in a bit of a losing pasture. So the normal, well-diversified, own a bit of everything, manage your risk that way, to me has never made sense. Why would I deliberately own something that's underperforming just so that I've got a nice spread? I would rather be a little bit smarter about stock selection and just try and focus on everything in my portfolio should be there because it's a performer. It's got a great growth outlook, it's got great management, and the share price has got momentum. Why wouldn't you want every stock in your portfolio to be like that? I've never understood the concept of being well diversified. Portfolio analyst last week was very much about trading in this new investing climate. So it was a big lead on from what I covered last weekend. That's it for this week. There's more information on the website. There's my email address, and I'll be back with you next Sunday. And next Sunday will obviously be the final video for this year. So I will talk to you then. Cheers.